Welcome back to FinScribble. Imagine walking up to a stunning suburban house with fresh paint, warm cookies on the counter, and an eager seller begging you to place a bid today because property values have never been higher. Do you eagerly rush in with your checkbook? Or do you step back and ask why they are so desperate to sell at this exact moment? Right now, financial markets are hosting that exact same open house. Wall Street is gearing up for what analyst projections call the biggest initial public offering boom since the mania of 2021. But before you jump headfirst into the upcoming feeding frenzy, we need to uncover who actually set the clock, why insiders are unlocking the doors right now, and what history tells us happens when retail buyers arrive late to the party. Look at the broader landscape unfolding right now across Silicon Valley. More than 40 massive tech startups are currently queuing up in the public market pipeline. The definitive tipping point arrived on June 1st, 2026, when artificial intelligence leader Anthropic filed confidentially for its own public offering, igniting an explosive domino effect across the private venture ecosystem. Unprecedented investor excitement around generative artificial intelligence has inflated private valuations to historical highs, creating a massive wave of capital eager to capitalize on public market demand. Venture capital funds that poured billions into early-stage software architecture, custom silicon, and frontier neural models are suddenly racing toward the exit doors. They recognize that current public enthusiasm presents a prime opportunity to convert paper gains into hard currency, transforming thousands of pending private shares into real liquid capital before market sentiment shifts. Here is the foundational truth that every everyday investor must understand about public markets. Companies do not choose their listing dates to make new retail buyers wealthy. Insiders, founders, and venture capitalists set the timing clock for one specific purpose: to sell. They possess a profound structural advantage known as information asymmetry. They know the intimate details of internal cash burn, customer churn, and actual revenue growth far better than any public prospectus could ever show. When a company files to go public during a high-flying market surge, it is not a celebratory sign of corporate adolescence. It is a calculated financial exit strategy. Private insiders spend years nurturing private companies, waiting patiently for the precise moment when retail optimism peaks, allowing them to hand over risk to the public market while collecting maximum payout for early investments. Think back to our open house metaphor from earlier. In 2021, hundreds of speculative tech companies rushed through public listings at astronomical valuations. What followed was a brutal wake-up call for Main Street buyers who eagerly purchased those shares at the peak. Once the lockup periods expired and early investors cashed out, many high-flying stocks tumbled 60 to 80%, leaving public shareholders holding the bag. A banner year for public debuts is not a green light signaling vibrant economic health. It is a bright yellow warning flag. When private funding dries up or private valuations reach unsustainable ceilings, public markets become the ultimate release valve. Insiders use the immense liquidity of public exchanges to offload asset risk, passing expensive valuations down to enthusiastic retail traders just as underlying growth metrics begin to normalize or show structural strain. To make matters far more challenging for everyday investors, modern fintech trading apps continuously promote new features like pre-IPO access allocations. It sounds like a fantastic democratizing tool, granting Main Street retail traders direct front-row seat access to hot startup debuts alongside institutional titans. But here is the hard truth behind institutional allocation mechanics. When institutional hedge funds and sophisticated pension managers pass on an offering, underwriters scramble to fill leftover order books by allocating extra shares to retail channels. In reality, getting 100% of your requested allocation on a hyped app isn't always a victory. It can be a clear warning signal that smart money stepped aside. When enthusiasm peaks and retail access reaches maximum availability, the risk-reward ratio reaches its most dangerous inflection point, exposing everyday retail portfolios to sudden downside volatility.
So, what should smart investors actually do when faced with the heavily hyped 2026 initial public offering wave? First, treat a banner year for public debuts as a yellow flag rather than an automatic green light to invest. Instead of rushing to buy on listing day during emotional market pops, exercise disciplined financial patience. Allow the initial hype cycle to cool, read the required S1 filing disclosures carefully, and monitor real earnings performance over multiple quarterly reports. Look for proven business profitability, resilient unit economics, and reasonable valuation multiples, rather than pure narrative promises. Don't let fear of missing out turn your hard-earned capital into someone else's exit liquidity. If you enjoyed this breakdown, hit that like button, subscribe to FinScribble for more sharp financial insights, and drop your thoughts in the comments below.
As always, appreciate you hanging out today. See you in the next one.